If you had $100,000 and had to choose between Fidelity Investments and State Street Corporation, which one would actually grow your money more? That's the question most investors never ask, and it might be costing them hundreds of thousands of dollars because on the surface, these funds look identical. Same categories, same markets, same idea. But once you run the numbers over 30 years, the gap is not small. We're not talking about a few $1,000s. We're talking about $500,000 difference. And that difference doesn't come from luck. It comes from structure. It comes from fees. And it comes from how these funds are built behind the scenes. So in this breakdown, John takes $100,000 and runs it through both providers across 5 categories. Fees, S&P 500. Total market, dividends, international. Same starting point, same timeline, same rules. Only one question matters. Which one actually wins? But before that, you need to understand one simple thing. What you're actually investing in, because most people think they're buying stocks. They're not. They're buying a system. An index fund is just a basket. Instead of picking one company and hoping it goes up, you own hundreds, sometimes thousands at once. That means your risk spreads out. One company fails, it barely matters. And most of these funds follow a benchmark like the S&P 500. They don't try to beat the market. They just mirror it. That's why the fees are low. No constant trading, no expensive managers. Just set it and let time do the work. Now here's where things split. Fidelity built most of its lineup using mutual funds. State Street built theirs using ETFs, different packaging, same core idea. Both track the same indexes. Both hold the same companies. The only real difference is how you buy them. Mutual funds price once per day. ETFs trade all day like stocks. But underneath, your money is going into nearly identical assets. So now the stage is set. Same markets, same strategies, same starting capital, but 2 completely different philosophies. Fidelity competes on cost. State Street competes on access and liquidity. One tries to be the cheapest. The other tries to be the most efficient. And over time, that difference starts to compound. So John starts with the simplest category first. Fees, because most people ignore them. And that's exactly why they matter. On paper, the difference looks tiny. 0.02% vs 0.09%. That's a few dollars a year on $100,000. But investing is not about 1 year. It's about decades. And every year, that fee gets pulled out of your portfolio. Then the next year, you earn returns on a slightly smaller base. Then the next year, again. And again, that's how small numbers turn into big losses. Over 20 or 30 years, that tiny gap can snowball into tens of thousands of dollars gone, sometimes more. When John compares the core funds, Fidelity comes out cheaper in the categories that matter most. Lower expense ratios, no account fees, no minimums. And that gives Fidelity the first win. Scoreboard, Fidelity 1, State Street 0. But here's the problem. Lower cost doesn't guarantee higher returns. And that's where things start to flip. Because the next round is not about cost. It's about performance. And that's where the real story begins. Now we move to the category everyone cares about. Growth, not fees, not structure. Just one question. If you leave your money alone for 30 years, which fund actually turns it into more? So John starts with the benchmark everyone knows, the S&P 500, 500 of the largest companies in America. Names like Apple, Microsoft, Amazon, Nvidia. If you want simple investing, this is where most people go. Set it, forget it, let it grow. Historically, it returns around 10% per year, sometimes more, sometimes less. But over time, it compounds. Now here's the matchup. On one side, Fidelity's index fund. On the other, State Street's ETF version, same index, same companies. So logically, you'd expect the cheaper one to win. Lower fees should mean higher returns. That's what most people think. But when John runs the numbers, something unexpected happens. After 1 year, both portfolios are almost identical. After 10 years, still close. After 20 years, the gap starts to show. And after 30 years, it's not even close anymore. State Street's fund ends up ahead by about $157,000. Same market, same companies, but one finishes with significantly more money. And here's why. Even though Fidelity is cheaper, State Street's fund had slightly higher price growth. Not by much. But over decades, small differences compound into massive gaps. That tiny edge in performance beat the fee advantage. And suddenly, the cheaper option loses. That's the first surprise. So now the scoreboard changes. Fidelity won, State Street won, completely tied. But the S&P 500 is only 500 companies. The real market is much bigger. Thousands of companies, small ones, mid-sized ones, hidden growth engines most people never think about. So John moves to the next round. Total market. This is where things get more interesting. Instead of just the biggest companies, total market funds try to capture everything, from giants down to small cap stocks. On paper, that sounds better. More diversification, more coverage, more opportunity. Fidelity's version holds nearly 3,800 stocks. State Street's version holds around 1,500. So you'd expect Fidelity to win. More stocks should mean better performance, right? That's the assumption. But again, the numbers tell a different story. After 30 years, State Street's fund is ahead by about $442,000. Almost $500,000 difference. And this time, it's not even close. So what happened? The extra 2,000 stocks in Fidelity's fund didn't help. Most of them are tiny companies. Lower growth, higher volatility. They added noise, not performance. State Street's fund focused on the stronger part of the market, large and mid-sized companies that actually drive returns. Less clutter, more efficiency, and that focus paid off. So now the scoreboard shifts again. Fidelity won, State Street 2. State Street takes the lead. And here's the pattern starting to form. More is not always better. Cheaper is not always better. What matters is how the fund is built, because structure drives results, and results compound. But so far, everything we've looked at is about growth, account size, portfolio value. The next round changes the game completely, because now it's not about how big your account gets. It's about what it pays you. Income, cash flow, the money you can actually live on. And this is where the biggest trade-off shows up, because the fund that builds the most wealth is not always the one that pays you the most. And the gap between those two can completely change your strategy. Now everything changes. Because up to this point, we've only talked about growth, portfolio size, account value, but none of that matters if your goal is income, because you can't spend portfolio value, you spend cash flow. Dividends, that's the difference. So John moves to the third category, dividend funds. And this is where most investors make a critical mistake. They assume the highest yield wins. More income must be better. But that's not how it works, because yield is only one part of the equation. The other part is growth. If a fund pays a high dividend but never grows, you fall behind over time. If it grows too fast but pays nothing, you wait decades to see real income. So the goal is balance, yield plus growth. That's what builds a real income stream. Now here's the matchup. On one side, Fidelity's dividend strategy. On the other, State Street's dividend ETF. Both designed to generate income. Both built from high-quality companies. So what happens after running the numbers? something very clear shows up. State Street wins again. Not just by a little, by a meaningful margin. And it comes down to one thing: consistency. State Street's dividend fund focuses on companies with strong cash flow and stable payouts. Not the highest yield, not the flashiest names, just reliable income that grows over time. That stability compounds year after year, while other funds chase yield and get cut during downturns. So now the scoreboard moves again. Fidelity 1, State Street 3. At this point, the pattern is getting harder to ignore. But there's still one more category that most people underestimate: international. Because almost every investor is heavily weighted toward the US. US stocks dominate portfolios. US companies dominate headlines. And for years, they've dominated returns. But markets don't move in straight lines. Leadership rotates. And when it does, the gains can be explosive. So John tests international funds next. On one side, Fidelity's global exposure. On the other, State Street's international ETF. And this time, something different happens. State Street doesn't just win, it dominates. The performance gap is wide, driven by exposure to regions that are undervalued: Europe, Asia, emerging markets. When money starts flowing into those areas, returns move fast. And that's exactly what happened. State Street's structure captured that shift better. So the final score becomes clear: Fidelity 1, State Street 4. And that's not what most people expect. Because on the surface, Fidelity looks like the smarter choice. Lower fees, more stocks, simple structure. But investing is not about what looks better. It's about what compounds better. And over time, State Street's approach delivered stronger results across most categories. But here's the part that actually matters. This isn't about picking one company over the other. It's about understanding why the difference exists. Because once you understand that, you stop guessing. You stop following the crowd. And you start building a portfolio intentionally. So now we step back. Same $100,000. Same timeline. Same market. Two completely different outcomes. And the gap between them isn't small. It's life-changing. Which leads to the final question: what do you actually do with this information? Because knowing which fund wins doesn't matter if you don't know how to use it. So after everything, the answer is clear. Same $100,000, same timeline, same market, but completely different results. And the gap is not small. It's the difference between a good outcome and a life-changing one. Because over decades, investing is not about big decisions. It's about small advantages, tiny edges that compound, a slightly better structure, a slightly better allocation, a slightly better fund. And those small differences don't show up in year one. They don't even show up in year 5. But over 20 or 30 years, they explode. That's the part most people miss. They focus on what looks good today instead of what compounds best over time, because the market doesn't reward attention. It rewards structure, and it rewards patience. Now, here's the mistake most investors make after seeing something like this. They try to switch everything immediately. They chase the winner. They move from fund to fund, trying to capture whatever worked last. And that usually makes things worse, because performance rotates. What wins in one decade might underperform in the next. We've already seen it. US stocks dominated for years. Then international surged. Growth led. Then value took over. Nothing stays on top forever. So the real takeaway is not pick State Street. And it's not avoid Fidelity. The real takeaway is this: understand what you own. Because once you understand the structure behind your investments, you stop reacting and you start building. You build a portfolio that balances growth and income. You combine different segments instead of relying on one. And most importantly, you stay consistent, because consistency is what actually creates wealth, not timing, not guessing, not chasing trends, just staying invested long enough for compounding to do its job. That's how $100,000 turns into something meaningful. Not overnight, but over time. And if you want to see exactly how to build a portfolio that does that, step by step, using ETFs that actually work together, click the video on your screen right now. That's where everything comes together.